Rakesh Arora, Managing Director and Head of Research with Macquarie Securities, joins us live. Rakesh, morning. Thank you for joining us. Rakesh, what are the sound bites you're getting from some of your clients after the GAR clarification?
See, obviously, this thing removes uncertainty, so I think it's a welcome move from the government. However, having said that, see, we are not really very hopeful of FI inflows picking up into India. Already we have seen $9 billion worth of FI inflows come into India in the first 4 months. And if I look at how investors are positioned, both Asia ex Japan and GEMS fund are largely overweight India. And the inflows into these funds have been actually reducing. They have seen outflows given the risk off trade that you just mentioned. So I don't think there's fresh money coming into these funds, and they're already overweight. They utilized the cash that they were sitting on. The only hope for fresh money is if allocations by global funds increase, because they are underweight India at the moment. And if they increase position into India, then only we can see sustained FI flows. So as of now, I think we've peaked out in terms of FI inflows, and probably it will be a trickle downwards, or outflows would be seen over the next few months. Now, historically, we have seen that whenever you see these kind of surges in FI inflows, which we have seen from Jan to April, normally the 12-month forward returns are negative, and this is because post a surge, normally there's a period where there are no FI inflows, and Indian markets are highly correlated to FI inflows. So I think we are seriously looking towards a 12-month negative return from here on.
Rakesh, but I mean, what is your sense of what would it take for the market to actually snap out of the range? In the near term, do you think, GAR being deferred is a move enough that would actually take the market higher from here? Or do you think it is going to be back to consolidation? What we saw yesterday was just a knee-jerk short recovery relief rally.
Yes, as I mentioned, we don't see fresh FI inflows coming in just because that GAR has been postponed by 1 year. So at the best case, it was going to be a short-term phenomena, and it does reduce uncertainty, but from a longer-term perspective, this is going to be helpful. So I don't think the rally can sustain just because of GAR. So we'll have to look for catalysts beyond GAR for markets to really break out on either side of the range. Hopefully things will improve. Inflation has come off a bit, and we are expecting that government would move to increase diesel prices in June, so that would reduce uncertainty on the fiscal deficit. And the most important catalyst remains oil price. It has also come off a bit. So if it remains at low level, government passes on a little bit of oil price increase, and you get a good monsoon, then probably you trend back to 5,600 to 5,800. But to break out of this range of 5,000 to 5,800, you really need some key reforms to go through, and investors to get confident that the growth rate of 8% plus can be re-achieved. So that is how I would say the market is poised at the moment.
Rakesh, at a time when Europe has said a resounding no to austerity, the US Fed has indicated that QE3 could be coming. Locally, the central bank, which is Reserve Bank of India, is in a cutting cycle. Why do you think foreign or global liquidity will not come to India?
See, what has happened in the last 2-3 years is that there's been a propensity to put money into emerging markets, because developed markets were, are not moving anywhere, and they were having their own share of problem. But while we do believe that money would flow out from bonds into equities globally, but the beneficiaries are going to be developed market rather than emerging market. And as I told you that already the India focused funds are already overweight. So what you need is probably a trickle in from global fund allocation increasing. But I think from the current situation, investors are hugely underweight on the developed market, and that is where the money will actually flow in if this kind of quantitative easing happens.
Let's look at sectors and your current recommendations. You are recommending your clients to buy consumer names, buy energy names, but sell industrials and sell rate sensitives. What's the thinking behind this?
No, see, what we are saying is that probably, developed markets are where the queue lies and they are going to recover first. So we are bullish on, IT, pharma, which are linked to global recoveries. At the same time, India consumption seems to be doing pretty well. And that's why we are mildly bullish on the consumer discretionary names. They are also helped by the fact that interest rates are softening a bit, and that should help support consumption. Now, on the other hand, financials and industrials, we remain underweight, largely driven by the fact that we don't see infrastructure cycle and capex cycle really picking up over the next 12 to 24 months. And banks yet to have see the full NPL cycle. So the pain because of lack of infrastructure and capex cycle is yet to be felt in the system. Also on banks, we believe that they are in for a structural decline in ROEs because Basel III norms have been notified, and that means more capital is required for lower growth. So that is going to put pressure on ROEs. So these two things put together, makes our call of underperform on financials and industrials.
Rakesh, since you track the metal space very carefully, is there money to be made in metals in the next 1 year?
We think that the commodities are more in a neutralish range at the moment because demand is pretty weak both in China and rest of the world. And while there have been some support to metal prices because of cost pressures, and also from the fact that most of the governments are trying to tax mineral resources quite heavily. So there has been support on the downside, but because of lack of demand, we are not really seeing any major rally in commodity prices. So in this scenario, you can't really go and buy a commodity sector per se all out. You will have to look for stocks where there are some volume growth stories coming up or some restructuring happening. So apart from that, largely we'll recommend an underweight.
So which end of the commodity market are you bullish on, are you bearish on? When I say which end, are you bullish on ferrous, non-ferrous, oil, natural resources?
Okay. We are, in terms of our preference, I think iron ore, copper and oil would stand as our key, overweight metals and minerals. And remaining, we are neutral to bearish on the other minerals here.
What is your view on the rupee for rest of the year? Closer to 53, 53 and a half. Do you think rupee is nearing the end of its decline?
It's difficult to quantify, what could be the short-term movements, but generally we are expecting 51 rupee as an average for FY13, and I think that should hold. We would see bouts of, 53, 54 as we are seeing at the moment, but I don't think that's a sustainable level.